This is MarcoVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MarcoVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck, listeners. You're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MarcoVoices.com. Just go to our homepage, MarcoVoices.com, and click on the red button over Anas's picture saying, looking for the downloads. Now, Eric, let's get to crude oil, starting with the EIA inventory.
It was a massive drawdown week, with crude oil printing a drawdown of 9.2 million barrels, Cushing, Oklahoma drawing down 2.0 million barrels. The builds were on finished products, gasoline building 4.9 million barrels. Distillates, though, still drawing down 1.4 million barrels. All of those things netted together is a net drawdown on petroleum products of 5.7 million barrels on the week. U.S. production was down a full million barrels a day to 12.3 million, not 13.3, but 12.3 million barrels. It sounds like a crazy data error or something. It's actually real. It's the weather. It really is too cold to pump crude oil in North Dakota this week, and there's a lot of production that's been shut in because of the extreme weather there. So that's the reason for the depressed U.S. production figure, which is actually a real number. Obviously, that weather anomaly is temporary. The question is, how temporary or untemporary is the recovery? Do we bang right back up to 13.3 million barrels next week as that production comes back online? Or is it going to take several months to crawl our way back up to 13.3 million barrels? That'll be the next thing to watch. Time spreads are looking very strong, especially at the front of the curve. The prompt spread, the very first month, has flipped decisively back into backwardation, which is a signal that the market is tightening, and it's oftentimes a prediction that flat prices will be moving higher in coming days and weeks. So let's keep an eye on this market for it maybe to move higher. We're starting to see that strength. We're also nicely above the 50-day moving average, and we're just coming up on the 200-day moving average at 75.42 on the contract chart. If we can get above that, it's another important technical analysis hurdle to get above. Much of the strength that we're seeing, though, is coming from weather disruptions and other events that are not really long-term. Certainly, the Red Sea situation has added a lot of political risk premium to this, but these things will eventually pass. So I don't think there's anything that's really in the system to take us to $100 crude oil prices. But again, the geopolitical situation is very much in a state of flux. Anything could happen there. And if we had a major escalation, it could change things quite dramatically.
Eric, while Anas had a great analysis of oil that it more or less is going to be far more range-bound and contained in its trend this year, I still think that there's plenty of potential for us to go back to last year's highs and then bounce around in that trade range. So we could still have a breakout here that sees even a $10 advance in crude oil before it probably comes right back into the range. The key here is that the pattern of lower highs and lower lows that was so dominant since September has really stalled. And the price action has been very distinct, which is that almost every single time we had one of these 1 or 2 day sell-offs of $2, $3, it was immediately accumulated and brought to the top of the range, and we're now trading above the 50-day moving average. We're seeing a basing formation that leaves lots of room for at least an oil advance into the mid-80s, and so we'll be looking here whether or not this continuation pattern continues. All right, let's move on to the equities. I want to get Nick involved in this conversation. Now, Nick, the S&P 500, a big explosive rally in this post-OPEX cycle here. We're near the 4,900 level. What are you watching?
Yeah, Patrick. So spot price right now in SPX is approximately 48.65. We have a call wall above at 4,900 and a put wall below at 4,800, which was previously the all-time high. The implied move for the February 16th monthly OPEX is plus minus 110 points. Therefore, the upper implied move is 49.75, just shy of that key 5,000 level, which everyone's talking about. And the lower implied move is 47.55. Key resistance above is at 4,900 and key support below is at 4,800. Now, as I mentioned last week, I thought we'd hit all-time highs, which we did. We pushed past them well beyond and pushed toward 4,900. I do see a pause in the markets here, followed by a decline into the February OPEX. But again, that's contingent upon two things. One is FOMC next week. And the second thing is earnings season, which has thus far kicked off with Tesla missing earnings so far, as well as Netflix beating earnings. What are your thoughts here?
Well, Nick, for me, the breadth of the market continues to deteriorate. When you look at the Russell, the way it gave back the initial gains, the way the equal weight S&P 500 index didn't make higher highs, this is a market that is relying more and more on the leadership stocks, the Mag 7s, to keep this trend going. Otherwise, we would need some sort of key sector rotation and a new leadership emerging. So this is why those earnings on a lot of these Mag 7s next week may actually decide a lot of this. Now, I think that it is would be incredibly normal for the market to at least print on a very short-term basis above 5,000 to give the media headline print of a big hurdle being beaten. But we're all seeing some of the momentum from earlier in the week now dissipating. So it's one of these areas where I don't see much upside, but no immediate reason for the market to reverse until we get to that key news next week. Like you were highlighting, the FOMC is on Wednesday, jobs numbers on Friday. We got earnings like on Apple and other ones like that late next week. And so really, I think that the big moves in the market are really going to be in February, going into that OPEX you just talked about. In the interim, between this period and next week, it wouldn't shock me if we tried to crawl up towards 5,000, but the momentum of the market is clearly going to keep a lid on this. Nonetheless, let's move on to the Qs. And what level are you watching on the NASDAQ?
Yeah, so right now in the Qs, spot price is approximately 427. We have a call wall above at 430 and a put wall below at 420. The implied move for the February 16th monthly OPEX is plus minus 14 points. I do expect that to be greater because of the tech earnings coming out the next few weeks, as well as FOMC. However, the upper implied move is 441 and the lower implied move is 413. We have key resistance above at 430, which are also the all-time highs, and key support below at 410, which are the previous all-time highs. As I said in previous weeks, I've been wrong for a while now. Tech is not where I place my bets. As you said, the breadth is weakening. I'm seeing too much money flowing into these large names, and I do think at some point it's going to turn around in a violent fashion. I'm more inclined to look at the small caps because, again, if we do push to that 5,000 level, I think we need to see an increase in breadth in order for that to happen.
It really is going to be decided by those earnings. Everything from Amazon to Google to Apple, Microsoft, everything is up to bat next week. And now there's always the chance that these are going to be beats, and that may actually be what drives another 100 S&P points higher as the NASDAQ leads the way for one more impulse. But really at this stage, it is going to simply be a storyline as to whether or not these Mag 7s have overshot or not. I mean, the semiconductors have been doing very well, and a number of these plays have just been where all that money flow continues to happen. And so right now, that resistance here, at least for the remainder of this week, is likely at the highs of yesterday. But I think that we're going to have some big movements starting next week. Nonetheless, let's move on to the volatility index, which has had numerous quick little pops, but we're back to the 12 handle. Volatility is definitely on the bottom end of its range, and no sign of fear coming from this index anyway. What levels are you looking at?
Yeah, so with the VIX at around 13, that denotes about 0.75% movements intraday, top to bottom. What I'm looking at is that I'm seeing a lot of these covered call and buy right ETFs selling premium on the call side and the put side. So this is what's been suppressing volatility, even though we've had expansions of ranges beyond what's expected. I do think it'll present a problem at some point in time, but when that is anyone's guess. Right now, I'm just being cautious in terms of what I'm doing with regard to premium selling. I'm waiting for ranges to expand and then selling premium on the upside or the downside, depending on where we move. But again, tracking those intraday ranges is very, very key on SPX in particular, because the VIX is predicated upon that. And I think we see perhaps a pop in volatility following FOMC and into earnings season as well. Now, moving on to page 7, we have the US dollar index, which has recently bounced off lows. What are your thoughts here?
The dollar's holding its own at 103 on the Dixie. It started to roll over on Tuesday night into Wednesday, but then as the PMIs unexpectedly beat expectations on Wednesday morning at 8:30, that kind of jolted the dollar back up over 103 as rate cut expectations for March were crushed by the PMI data. Now, I think if you take a step back and look at that PMI data, is it really telling us that there's a systemic change, that inflation is back? Or is it just telling us that this Red Sea disruption and screwed up supply chains around the world, and maybe it's just a temporary friction that we're seeing on those PMIs? Not sure what it is. We'll have to keep an eye on the data, but the question of whether or not inflation risks are really behind us is very much reinvigorated by that PMI print.
I find it fascinating that we're at this level here, Eric, because when you put in context the sell-off that we've seen through the months of November and December, we had a 2-month sell-off that saw the Dixie go from 107 down to below 101. And now we've pretty much 50% retraced that sell-off. And we find ourselves right at this pivot with us recording this right before the ECB press conference and the FOMC next week. And it'll be really interesting to see whether these central banks really get a new currency trend underway. Right now, if the dollar index can't beat this 104 to 104.5 level on the upside, it is very common for retesting of lows or establishing a basing formation before any advance. So assuming that this doesn't have a big move on the ECB, I wouldn't be shocked if we had temporary stabs down toward 102 on the dollar index. But in general, the dollar, I think, is establishing a low from which it may potentially rally later in the first quarter of the year. Right now, though, it's going to be all about these central banks.
Now, moving on page 8, we have the gold futures chart. What are your thoughts here?
The gold chart was actually looking pretty strong with the February 2024 contract at almost $2,040 before the U.S. PMIs unexpectedly beat expectations at 8:30 on Wednesday morning. That caused rate cut expectations for March to collapse, and that caused crude oil to collapse $25 lower in almost as many minutes. We're getting closer and closer to that 1985 level. Below that level, you'd have to say that we have a new pattern of lower swing lows on the gold chart. We haven't gotten that yet, but we would be seeing a pattern of lower lows if we got to 1985 or lower. I'm still hopeful that we're going to hold above 2,000. We'll get about a $20 boost, or the illusion of a boost, from the contract roll when we roll from the February to the April contract. The contango in the market will cause the continuation chart to show as if there was an overnight increase of $20 in the spot price, although that's not really what's going on there. It usually has the effect of helping sentiment in terms of giving people the impression, I looked at it a couple days ago, it's $20 higher now than it was then. Actually, the price didn't change. It was just the contract roll. But that usually fakes everybody out, and it helps to build bullish sentiment even when it shouldn't. At least I hope that's what's going to happen. If we get an actual sustained move on the continuation chart below 1983, that's the 100-day moving average, you really have to start to wonder what comes next after that. In this ascending triangle pattern that we're in, you can get back down to 1900 before you violate that lower trend line. So I think there will be a move to higher gold prices before year end for sure, but markets love to shake out the weak hands before they deliver that ultimate move higher, and a washout down to the 100-day moving average at 1983 or even a move below that is not all that difficult to imagine from here.
Well, when I'm looking at this gold chart, we're still a stone throw away from all-time high, and it is a very, very bullish chart. We are clearly, though, have started a consolidation of some sort. The bigger question, is this a short-term consolidation the way we saw in February going into early March at the start of last year that explosively started another key leg higher? Or is it going to be a prolonged trade range that we saw in the summer of last year? One way or another, I think that it will resolve itself bullishly on gold, but it's really going to be about how, kind of sizing up where and how long the sideways consolidation plays out before the setup for the big gold breakout.
Now, on page 9 here, we have the uranium chart, which Eric's been discussing for a couple of weeks now. It's been on a pretty crazy run. Eric, what are your thoughts here?
As I mentioned last week, the big breakout above $100 on the spot uranium chart left a lot of gaps on various uranium mining charts, and I've been buying those gap fills all week. The slow stochastics on several of those charts suggest that this correction may still have farther to go to the downside, even beyond those gap fills, but I definitely see this as a buy-the-dip opportunity in uranium miners. Maybe we still have a little bit more to go before the correction is over, but one way or another, buy the dip.
Yeah, well, for me, Eric, the U308 contract, I want to see it stay above the 100 level on a sustained basis. I mean, a short-term break below 100 and then pop back above can always happen on a short-term basis just on liquidity. But I generally want to see whether or not the bulls are buying all dips. On the U.UN, the Sprott Physical Uranium ETF, that would be around the $30 level. And so we're going to see whether the bulls defend this and start accumulating dips here. Generally, the bull trend is quite intact. The profit taking in the bull run happens all the time. The biggest question, of course, is simply, will the dip be bought? And I think we're going to slowly be approaching here levels that should be accumulated if that trend remains intact. Finally, though, Nick, I want to just touch on page 10 where I have the 2-year T-note futures. I just thought this was interesting because we're going to have the FOMC announcement and press conference before we record another episode. And obviously the 2-year note and the 2-year yield are quite sensitive to the path from which people anticipate the Fed funds rate to go. And clearly we went from a March meeting chances of a rate cut being well over 50% to now only a 44% chance, which is basically now the rate cuts are now being pushed to the May meeting. And if we continue to see half decently strong economic data, big question in my mind is, does that cause the Fed to continue to stay in their pause mode for longer, and the market is simply getting too excited about a new rate cut cycle too early? And right now, watching the FOMC and whether or not the 2-year bond actually breaks out on that with some sort of a dovish tone, or whether or not Powell just continues to kind of talk the game of wait and see. It's going to be interesting to see how it plays out.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.